The Kenya Electricity Generating Company plans to raise funds from the market later this year, and it may opt to issue the country's first green bond. KenGen has a 1,631 megawatts annual capacity, and it supplies 70% of the East African nation's electricity. Private investors hold 30% of the company, while the rest is held by the state. Rebecca Manu, KenGen CEO, says the company would go to the market once it redeems its 10-year, 25 billion shillings bond in October.
Kenya's capital markets regulator is set to unveil regulations for private issuance of green bonds next week, paving the way for the first issue. The green bonds help to finance projects in the renewable energy, energy efficiency, green transport, and wastewater treatment sectors.
Financial team are looking at asset-backed security. They're also looking at green bonds. Those are the kind of vehicles we are looking at. We are looking at joint ventures, a diversified portfolio financing our projects. Of course, that is to strengthen the DFIs, which are the conventional concessional funding.
Although Kenya has high consumer electricity tariffs compared with countries like Egypt and South Africa, the government's policies had boosted investment in the sector, helping it to avoid blackouts or schedule cuts.
Geothermal, being our focus, sort of mitigates when we have lower hydrology, and our geothermal-led strategies, that is bearing fruit. And you can see we are not having any sort of power outages or rationing because we are able to fill in the gap.
KenGen has shifted its strategy in recent years to focus on renewable energy in order to reduce the risk posed by its hydro generation dams, which are normally susceptible to a drop in production when the rains fail. KenGen paid a dividend to shareholders for its year ended last June, breaking a 2-year dividend drought associated with the cost of building a new geothermal plant and installing additional capacity in existing plants.
The Nigerian stock market took a heavy beating at intraday the morning after the postponement of the election. In about 40 minutes from now, the market will wrap up. Let's get an update from Temple. Hello, Temple. It's certainly not a good one for the equities market. Feed us in with the latest development.
So we're seeing losses across all the major sectors in the market at this point in time. We're down in the banking sector of the market, and that's the worst hit at this point in time, down some 3.63%. And after that, you have the consumer goods segment of the market. In spite of some of the earnings that has been declared in that sector, we're still seeing losses in the region of 3.11% in terms of consumer goods segment of the market. Of course, if you also look at the industrial goods segment, it's down. If you look at insurance, if you look at oil and gas, investors are selling down quickly as a result of the postponed election, which has now left so much of impact in the market. The key benchmark index at this point is down some 2.72%, and we've seen the key benchmark index returning to the 31,000 region. Ditto for the equity capitalization, which was earlier at 12 trillion naira. It's now back to 11 trillion naira. It tells you that a lot of investors are currently bearish in the Nigerian capital market, and it's basically due to the losses that we've seen. It's basically due to the postponement of the polls. If you look, of course, at the fact that we have Nigerian breweries, one of the key heavyweights in this market, releasing its earnings into the market. Yes, it came with the battered earnings, but it declared some 1.83 kobo in terms of dividends to investors. A lot of investors are selling down on that as well. Nigerian breweries is down some 8%, if not more by now. Transcorp, which also has a 3 kobo declaration in spite of a bonus that is yet to be fixed, that is also down in terms of its share price. So basically, both foreign and domestic investors are currently giving cold shoulder to the Nigerian stock exchange at this point in time. And with the level of losses that we've seen so far in the market, we do not see anything changing it for the better or for the positive before the close of the market until the election changes. That's the kind of negative sentiment we're likely going to see for the rest of this week until something really positive happens, or maybe when the election eventually happens on Saturday. Then that leaves us till next week, when investors will now be able to take their decision on the market. Shimezi.
Well, let's keep our hopes high, Temple. That's all I can say. Thank you. And Ghana's oil production is expected to increase to 500,000 barrels per day by 2025. The Minister of Finance, Mr. Ken Ofori-Atta, says that overall crude oil production is expected to increase from 196,089 barrels per day in 2019 to 420,020 barrels per day in 2023. The first oil from the Aka fields is expected between the last quarter of 2020 and first quarter of 2021. And moving on now to Libya. That country is in talks with U.S. firm to build a huge port to create jobs in an underdeveloped area in eastern Libya. However, archaeologists warn that the construction work would damage some world-class ancient Greek ruins nearby.
A white foundation stone next to a deserted beach near the sporiferic Libyan port of Susa is all to show for a 7-year dream to build one of North Africa's biggest ports. Yet officials say Libya is now in final talks to award a U.S. firm a $1.5 billion deal to set up a mega port intended to transform the coast where families go for picnics into a vast container hub. Texas-based security firm says it planned to sign a 35-year deal to build and operate the project in a region once occupied by the ancient Greeks before handing it back to the local authority.
After goods are unloaded off these pivotal ports, they are moved to dry ports. These dry ports are made of vast spaces in the Libyan desert, where goods are exchanged from north to south, and vice versa. Once the Libyan state begins investment projects for port establishment, regardless of the location, our project concerning railways and road will also take place.
Ravaged by fighting between rival groups and split into different administrations, Libya urgently needs jobs for youth who otherwise look to a bloated public sector or take up guns to earn their daily bread. Beyond oil, Libya has little successful economic activity, even importing milk. The port could provide 2,500 jobs. For starters, Libya still needs to fix its potholed roads and build a railway infrastructure. The road from Sasa to the next large city, Beida, for example, is unsuitable for trucks as it curves round steep cliffs with spectacular views of Roman rock tombs but no fence. Some also fear a port may damage ancient historical sites.
Our greatest fear regarding this project is when the road extends from the town of Susa to the town of Tokra. It will have to pass through historical sites in the city of Ptolemais, which is a city from the Ptolemaic era and rare era of the Ptolemaic. When the road passes through the city, it will affect the ancient site.
To counter some concerns, the planners say the port will be built 5 kilometers outside Susa. Their goal is for Libya to fully exploit its privileged Mediterranean location to become a major commercial hub between Africa and Europe.
And finally, Ethiopia and Djibouti have signed a deal to build a pipeline to transport Ethiopian gas to an export terminal in the Red Sea state. Ethiopia found extensive gas deposits in its eastern Ogaden Basin in the 1970s. China's PolyGCL Petroleum Investments has been developing the Kalub and Hilala fields that since signing a production sharing deal with Ethiopia in 2013. The agreement between Djibouti and Ethiopia comes more than a year after PolyGCL signed a memorandum of understanding with Djibouti to invest $4 billion to build the natural gas pipeline. And that's it on the program. Thank you very much for watching. I'm Chimezi Obi Iwago.